Hello and Assalamu alaikum everyone. A very warm welcome to the Advanced Audit and Assurance Smart Course. I am your tutor, Kashif Kamran. Today is the lecture 3 of the block 1, and let's see what we have in store for the lecture 3 of the block 1. Now, since we started the course, we have been in block 1. We've already covered the lecture 1 and the lecture 2, which has been focused on money laundering as a topic and the past papers of the money laundering. Now, today in the lecture 3 of the block 1, we'll be exploring another topic. Now, the block 1 of the syllabus, which is primarily known as the knowledge block of the syllabus and has a moderate exam focus because you do get questions on this topic on an occasional basis. Inside this block 1, we have covered money laundering as a topic, but the topic we are doing today in the lecture number 3 is professional liability of an auditor. There is one article on this, which is known as Auditor Liability. You can find this article on the Google Drive, where you have the Block 1 notes and Block 1 articles. So you click the folder of Block 1 notes and articles, and you will find the Auditor Liability as an article there, which you should start reading after the class gets over today. There is just one exam paper on it, and a very old one. So this has not been a very focal area of the AAA examiner. The only question available is way back in June 13 exams, Spaniel Company, question number 4A for 12 marks. So we have to do this question number 4A from the June 13 exams for 12 marks to see what is the examiner mindset. No recent questions on this topic, right? That is the only one question. So that speaks of the significance of this topic for exam perspective. Yes, there is an article, so you should start reading the article after the lecture 3 ends today. So let's resume with topic 2, professional liability of an auditor. And I'm taking on my Word file, which I use in every lecture. I hope you can see the Word file in front of your screen now. Lecture 3, block 1, and the topic is topic 2, professional liability. So let's start discussing this very important topic, though the exam focus is very low. So the objective today is to discuss professional liability as a topic and the past paper. Professional liability and the past paper practice. So we'll do all that today. So let's start the journey. Now, first of all, it is very, very important that all of you understand that when we say liability of an auditor, right, you need to realize that auditor can be liable, is liable, and can be liable provided the auditor do negligence. If the auditor is negligent, he will be liable. But who can make auditor liable? Who can file a case against the auditor? Because we know the auditor issue a report, and the report is relied by not just the shareholder, the report is also relied upon by the stakeholders. So can only the shareholder makes the auditor liable, or the stakeholders can make them liable? And is auditor liable? Number one. And if we say auditor is liable, then when? So there are lots of questions which you should have in mind before we start this topic. Let me put those questions as an objective for professional liability. So when we are understanding this topic, professional liability, what should be the outcome of this topic? Let's decide the outcome. Learning outcomes, which you will be taking from this topic. Learning outcomes. I think the first learning outcome you will gain from this topic, number one, is auditor liable? So we'll need to get to answer for this. If we decide in the lecture today that auditor is liable, then when is the auditor liable? When is the auditor liable? What circumstances make him liable as an auditor? So is the auditor liable? We need to search for the answer. Then when is the auditor liable? Number two, right? Number three, who can make auditor liable? Who can make auditor liable? Shareholders, or stakeholders? Can the shareholders make the auditor liable, or the stakeholders can make them liable? Because stakeholder is a big terminology, right? Stakeholder includes shareholder, but shareholder is a narrow terminology. It is only shareholders, right? It does not include any other stakeholders. So who can make auditor liable? The shareholders or the stakeholders, or like both of them, or both of them? So we need to find the answer to that question as well. So who can make auditor liable? That's important. And the lastly, how can the auditor limit or reduce? How can the auditor limit or reduce the liability? How can you reduce your liability arising from your negligence as an auditor? So these are four questions which will set the outcome of the topic we are discussing today. So are you all ready, and can you all see the word file with the four questions in front of you? So we need to search answers for these four questions, and that will wrap up this topic. Are you all clear with the four questions on screen? Can you all see that? Okay, thank you very much for confirming that. Okay, let's go back and start searching for the answers. You need to understand something very carefully at the start of this topic, that auditor issues a report, right? Auditor issues an opinion. Auditor issues the audit report, sorry. And that is relied upon by many. Is that true? Is that false? The auditor report is relied by many when they're taking their decisions about future. So the audit report is not just relied by the shareholders, though primarily the audit report is addressed to the shareholder, right? But the audit report is relied by many. So let me add another question here. I think that would be good enough. Is the auditor liable? When is the auditor liable? Who can make the auditor liable? And with that, who can make the auditor liable? Is the audit report is relied upon by many, not just shareholders, not just shareholders. Is that true? So that's what we need to focus on as well in the learning outcomes. And that's what we're discussing just currently, that the audit report is such an important document that it is not just relied upon by the shareholders when they are taking a decision about the future of the company. The audited report is also relied by the regulators, by the tax authorities, by the stock market, by the potential investors, by the major suppliers of the company, by the major customers of the company. So lots of stakeholder do take interest in the audit report, but can they all make auditor liable? That's very important. So let's start to discuss the journey on the liability of an auditor. Let's start to discuss who can make them liable, because the audited report is relied by many, but can the many make them liable? It's important. Professional liability of the auditor. What are we discussing inside this topic? Number one, we are discussing negligence, because if the auditor is negligent, then only he can be liable. So first thing which has to be proven is the negligence of the auditor. If you can prove that the auditor was negligent, he will be liable. But to prove negligence, you should have evidence. To prove negligence, you should have proper support to prove auditor is guilty of negligence. Number two, we'll be discussing the shareholders versus the stakeholder. Is the auditor only liable to shareholder, or is the auditor liable to stakeholders as well? Even though I'm giving you a hint in my lecture that the audit report is relied by many. Then we have to discuss a very important historical case, which is known as the Bannerman case. And the Bannerman case will be very, very important to decide is the auditor liable to stakeholders or not. So Bannerman case is an important case to decide is the auditor responsible to stakeholders or not. So that is a historical case in UK, which really opens the mindset and really opens the exposure of liability for an auditor. And lastly, we'll be discussing how can the auditor limit the liability? How can the auditor reduce the liability arising? So these are the four parameters on which we will be having the lecture 3 today of block 1. So let's start the journey with number 1, negligence. How to prove negligence? Now, you need to understand that the auditor can do errors while the auditor is conducting the audit. Now, the auditor can do a mistake while he is doing the audit, because there is a human error possible, right? We know audit is done by an audit team. There is a human involvement in the process of the audit. So many times in the audit, we exercise judgments, and our judgments can be wrong. So if you did a mistake as an auditor, and if you did an error as an auditor, which was unintentional, that's fine, because unintentional mistakes cannot be considered as your negligence. But if you have done something with an intention, it is more serious. Yes, the shareholders can even make you liable for something done unintentionally, because even if you do something unintentionally, the shareholders can suffer a loss. A shareholder can suffer a damage. So if you have exercised a wrong judgment, which was unintentional, the shareholders must have suffered because of your wrong judgment. So even if something has been done unintentional, you will be caught up. But the negligence is at a lower level. But if the negligence has been done deliberately, uh, with the involvement of the management, you have been bribed by the management, you have collided with the management, just like the case of the Enron and the Arthur Andersen, where Enron management bribed the audit firm Arthur Andersen, and the Arthur Andersen was collided with Enron, and they together did something wrong. So that is the higher level of negligence, right? So negligence can be unintentional, you will still be caught up. But if the negligence is intentional, is deliberate, you were involved with the management to conceal something from the shareholder, you were involved with the management to do the window dressing of the financial statement, then that is something very, very serious. I hope you're getting my point here, right? So there are two aspects of negligence. One is a human error, one is a mistake, which is unintentional. The other is the deliberate concealment of facts from the shareholder, or deliberate involvement of the auditor with management to window dress a financial statement, just like the Enron scandal, where Arthur Andersen, the audit firm, did the same. So negligence, first try to understand the parameter of negligence, right? Let me take the word file. So number one, we are first proving negligence. Now, in terms of negligence, the first thing for the class today, you need to understand there are two types of negligence the auditor can do. One is an unintentional negligence, and one is intentional. Obviously, uh, both cannot be the same in terms of an offense on the auditor. Both cannot be the same in terms of a penalty on the auditor. The penalty of intentional is severe. The penalty of unintentional is less. The liability of unintentional is less. The liability of intentional is more. I hope you're getting my point. So there are two types of negligence by the auditor: unintentional, which is simply a mistake, error, and something not done deliberately. But intentional is something which the auditor did deliberately, with collusion with management, etc. So that is more serious offense on the auditor, right? Now we know the auditors don't have a very clean record. There have been bad practices among the audit professions and among the audit firms, and there have been so many famous scandals where auditors have been involved in the corporate crime with the management. So there is a history of bads with the auditor as well, and you need to realize that when we are discussing this topic. So negligence of the auditor can be unintentional and intentional. Now, the negligence has been done by the auditor. How to prove it? Let's go back and discuss how to prove the negligence. I hope you're all clear on negligence, right? Before we start, how to prove it. Okay, that's great. Okay, now how to prove negligence? We are not sure who is proving it, whether the shareholder is proving it or whether the stakeholder is proving it. But let's see, whoever is proving it, how to prove it. The injured party must prove. Who is the injured party? The injured party can be a shareholder, or the injured party can be a stakeholder. We are not sure till the time we decided. But the injured party, the one which has been affected because of the negligence of the auditor, is that clear? So the injured party is the one which has been affected because of the negligence of the auditor. Now, the injured party must prove, to make auditor liable, duty of care enforceable by law exist. The injured party who has suffered because of the auditor negligence must prove that the duty of care between the auditor and the injured party, the duty of care between the auditor and the injured party, enforceable by law, exist. Now try to understand this. You need to prove in the court of law as an injured party that between me, the injured party, and the auditor, there was a duty of care. There was an agreement. And the duty of care was enforceable by law, which exists. Now you need to understand that the duty of care by law definitely exists because there is an audit engagement letter. You sign an audit engagement letter at the start of the audit. You issue an audit engagement letter at the start of the audit. And as an auditor, you have a duty of care, which is between the auditor and the shareholder by law. If you look at the law, if you look at the Companies Act, which you study in the law paper in ACCA, when you look at the word law, the law says the auditor is liable to the shareholders because auditor report is addressed to the shareholder. The shareholder appoints the auditor. The shareholder removes the auditor. So automatically, by virtue of this shareholder appointing you, the shareholders is the principal of the auditor and the auditor is the agent of the auditor. So is there a duty of care between a principal and an agent, between the auditor and the shareholder? And is that something you study in the law paper in ACCA, that there is a principal agency relationship? So if the injured party is a shareholder, definitely there is a duty of care enforceable by law. So the first thing, if you want to prove negligence, right? Okay, to prove negligence, number one, the injured party must prove, number one, the duty of care enforceable by law exist. Now this is very careful line. Enforceable by law, duty of care. That's one. And this duty of care was enforceable by law exist. Now try to understand the relationship of an auditor and a shareholder in the law. Now, when you look at this particular area, you need to understand that when we look at the shareholders as an injured party, shareholders versus the auditor. Now tell me, shareholders versus the auditor, there is a relationship, right? There is a relationship known as agency relationship, right? And when you look at this relationship, agency relationship, there is a relationship known as an agency relationship whereby the shareholders are the principal, right? And the auditor is the agent. So do you believe this is the duty of care between the auditor and the shareholder? And this is existing by the law? This is existing by the law. So by virtue of being under the agency relationship, the shareholder appoints you as an auditor. The shareholder removes you as an auditor. The shareholder remunerate you as an auditor. So the shareholder and the auditor have a relationship, right? And this relationship is known as an agency relationship. And this relationship is basically known as the duty of care. So when you are under a relationship, there needs to be a duty of care which needs to be exercised. So when you are performing the audit, you need to perform a duty of care when you're performing the audit. You need to be professionally skeptical when you're performing the audit. You need to exercise your professional behavior when you're performing the audit. And you need to perform the audit in a very proper manner so that there is no negligence. But if there is a negligence, the injured party, if that injured party is a shareholder, they will go to the court and tell the court that I am the shareholder and the auditor is my agent, and there is a duty of care between me and him. So the duty of care enforceable by law exists. Is that easy to prove in the case of the shareholder? Tell me. In the case of the shareholder, is that easy to prove? I think this is more implied. This is more automatic. This is more implied. This is more automatic. So this, in the case of the shareholder, just 1 minute. In the case of shareholder, the duty of care by law exists, is easy to prove, as this is more automatic, and implied by virtue of the Companies Act, by virtue of Companies Act, which you study in the law paper, by virtue of the Companies Act 2006, which you study in your law paper in ACCA, right? So there is a duty of care, right? And this duty of care is also signified by the aspect that at the start of the audit, at the start of the audit engagement, an engagement letter is signed. And this signature of an engagement letter, this signing of the engagement letter between the client and the auditor is again ensuring that the duty of care by law exists. So this is a letter signed between the auditor and the client. And the client is on behalf of the shareholder, right? The auditor and the client. So this letter also signify that the duty of care exists. So the shareholders can take the engagement letter to the court as an evidence that you see the duty of care exists. Even though there is no engagement letter, you don't need an engagement letter because there is a Companies Act. And the Companies Act is telling there is a agency relationship, which is very, very important. So the agency relationship is something automatic, is something implied, even though you don't have an engagement letter. But the good thing is you have an engagement letter. So is everyone clear with the duty of care enforceable by law for the shareholders? We're not discussing stakeholders currently, right? We'll see later what is the case of a stakeholder. Can a major customer, can a major supplier, can a bank go to the court and say, I have a duty of care with the auditor. The auditor has a duty of care with me. It's very difficult in the case of a bank, a customer, a supplier to prove that a duty of care exists. But in the case of a shareholder, by virtue of the agency relationship, by virtue of Companies Act, by virtue of an engagement letter, it's very clear. So the stakeholder case, can the stakeholder say the duty of care enforceable by law exists? Can a stakeholder prove it? We have to decide it in the next couple of minutes. But is everyone clear on the shareholder, the injured party, right? Okay, let's move to the next one. The duty of care exists. So you have to prove the duty of care exists. That's easy. Next, the duty of care was breached. That's important. The duty of care exists. That's so easy. You need not to prove anything. But the duty of care was breached. You have to show support and evidence why you believe the duty of care was breached. Where is the negligence? So breach is basically the negligence. So you have to show evidence for this as an injured party. You need to prove in the court of law that what is basically the breach, and you have to show results of the breach to the court. So duty of care was breached. Number two, duty of care was breached. Now, this is something where you have to do the arguments in the court of law, right? Duty of care was breached. So the injured party must give evidence or documentary evidence, in the court to prove that the duty of care was breached, because you are allegating the auditor, right? When you say the duty of care was breached, are you putting a allegation on the auditor? And the allegation should have evidence and documentary support, right? Without that, you cannot allegate the auditor. So when you're saying the duty of care was breached, so breached is equal to negligence. So that is an allegation on the auditor. So when you are putting an allegation on the auditor, you should have sound evidence to prove that in the court. Otherwise, the court will say, no, the auditor is not negligent. So as a shareholder, can you file a case against the auditor? Number one, yes, because the duty of care by law exists. So can you take the auditor to the court as a shareholder? Yes. But in the court, you have to give evidence that it was breached. Now that's very difficult. You should have proper supports to show in the court that the auditor did something wrong. And because you are allegating the auditor, you are saying it was breach. Breach means you're saying auditor was negligent. And if you are saying auditor was negligent, you are allegating the auditor. And the allegations cannot be verbal. It should have supports, right? So breach is equal to auditor is negligent. Auditor is negligent. And when you're saying auditor is negligent, is equal to allegation on the auditor, and this must be proven, is equal to this must be proven by the injured party. Am I right? And are you all clear? By the injured party. right? So the shareholders can take you to the court, but in the court, they have to decide that it was breached, and the court will be looking for the evidence you present against the auditor. If the duty of care was breached and you can give results, the auditor will be held negligent, auditor will be held liable. And the last thing is that as a shareholder, you have to prove breach here, which is to be proven, caused loss. You suffered loss. You suffered loss of wealth because of the mistake the auditor did. So if the auditor issued a wrong opinion or a wrong audit report, because of that, the share prices went down, and the share prices went down. And as a shareholder, I suffered a loss of wealth, which I had in my shares in a company. So the breach caused loss. And how much is the loss? You have to prove that. The breach caused loss. Now, the court will ask you, the breach caused loss. So the court will ask you to quantify the loss. So the injured party must quantify the loss, which is basically the liability, which is basically the auditor liability, right? So auditor has to pay this, right? Auditor liability. So the injured party must quantify how much loss the injured party has suffered, because the loss injured party has suffered will be the liability of the auditor. So injured party must quantify the loss. And when they're quantifying the loss, again, they have to prove it. So quantify the loss is equal to, you need to have evidence to support it. So the injured party must have evidence to support the loss. So it becomes, the court can understand it. Is everyone clear with the loss amount, which you must have suffered, right? So three things. Now, if you are a shareholder, tell me, can you file a case against the auditor? Do you have the power under the Companies Act? Tell me. Yes. Is that something automatic? Is that something implied? Right? So number 1 point is easy. Duty of care enforceable by law exists. Number 2 point is where you have to prove it. Breach. So is breach something of an allegation? And is that something which the injured party must prove? Right? And finally, the breach caused a loss. So you have to quantify the loss. And if it is proven that the loss indeed occurred because of the auditor negligence, so who will pay off this loss? The auditor. So that becomes the auditor liability. So are you clear on the three parameters? Okay, great. Okay, let's go back. Auditor liability. Yes, Melissa, we'll be coming to the answer, the way you should be answering the question. You're just getting the knowledge part here, right? So just don't forget, just forget about the answers currently. The auditor liability for negligence, right? Is the auditor liable for negligence? Two things needs to be discussed. We just discussed the case of a shareholder, right? And the case of the shareholder is easier. Do you agree with me? Because a shareholder is protected by the Companies Act. True? The shareholder is protected by the Companies Act, and the audit report is issued to the shareholder. Have you ever seen the audit report to the stakeholder? No, the audit report is to the members of the company. The audit report is to the shareholders of the company, which is the title of the report, right? So the shareholders is protected. They can file a case against you. But what about stakeholders? Even though the stakeholder rely on the report of the auditor, let's find the answer now. When you look at the auditor liability, we need to divide the auditor liability into two parts, the shareholder part, which we have just covered, and the third parties, which is basically the stakeholders, which we will start now. The third parties is basically the stakeholders, which we are starting. So auditor liability in context of a shareholder, we just covered that. Now the auditor liability for a third party, which is basically the stakeholder. When we say the auditor liability for shareholder, there is a liability in contract. And I've just explained to you that. Auditor and the shareholder have a contract under the Companies Act. There is an agency relationship. And they have a contract known as an engagement letter. So can the shareholder file a case against you? Yes. Can there be a liability on the auditor? Yes, because there is a liability in contract. What is contract? The Companies Act. What is the contract? The engagement letter. So is that clear to all of you? The liability in contract? That is something we just discussed in the last 5 to 10 minutes, right? The duty of care by law exists, right? Third parties. Now, we don't have a contract with the third parties. As an auditor, I don't have a contract with banks. I don't have a contract with customers. I don't have a contract with a supplier. I only have a contract with shareholder. So what what will happen if a stakeholder has suffered a loss because of the auditor? What will happen if the stakeholder is the injured party? For the third parties, it is liability in tort. Liability in tort. Now we need to understand what a liability in tort is. So let's explore liability in tort and let's see what is the case of a stakeholder. How can a stakeholder make you liable? Okay, let's get back here. Now we need to have a discussing point here, a discussing point by the tutor. Now the discussing point by the tutor here is, which is important. The audit report is addressed to the shareholders of the company, and that is the title of the audit report, right? Title of the audit report. You have never seen a title of the audit report. The audit reports to the stakeholder. So the audit report is addressed to the shareholders of the company. So shareholders are protected and shareholders can file a liability against the auditor if they prove auditor was negligent. That's clear, right? So that is basically the duty of care by law exists in the case of the shareholders. Now, this is important. Now, come to the second discussing point here. And the second discussing point is, what about stakeholders who rely on the audited financial statements, who relies on the audited financial statements, even though the audited report is not addressed to stakeholders, even though the audit report is not addressed to stakeholders, and there is no liability in contract. There is no liability in contract between the auditor and the stakeholder. I hope you agree with what I just wrote in the second discussing point. Can you all just read the second discussing point and tell me, are you clear? There is no liability in contract between the auditor and stakeholders, right? Now that is a problem. If there is no liability in contract between the auditor and stakeholder, the audit report isn't addressed to the stakeholder, then what the stakeholder can do? How can the stakeholder take the auditor to the court if the stakeholder, a major customer, a major supplier, or a bank has suffered a loss? Now that is a point when we come to a situation known as liability in tort. Liability in tort versus stakeholder. Are you all ready for this? Liability in tort versus stakeholders? Let's highlight it and let's start it. Okay, now liability in tort is what? Liability in tort is basically, tort means auditor has a journal responsibility to conduct a good audit, irrespective whether your audited report will be relied upon by who. You are not concerned about who relies on your report, right? The tort means the auditor has a journal responsibility to conduct a good audit, irrespective who relies on the report, irrespective who relies on the report. So as an auditor, this is your journal duty of care, right? This is a journal responsibility or a journal duty of care to conduct an audit, irrespective who relies on the report. So you have a journal duty of care as an auditor, not the duty of care by law, right? The duty of care by law is for the shareholder. So as an auditor, you are a professional, right? And as being a professional, you need to have a duty of care, which is a journal duty of care, irrespective who relies on the report. Now try to understand this. When you look at the code of conduct, if you remember the code of conduct from the AA paper, or if you've studied the block 2 of my syllabus, code of conduct includes something which is known as professional competence and due care, right? And the code of conduct includes a terminology known as a professional behavior. Is that clear? Is that part of the code of conduct? The 5 code of conducts for an accountant, everyone? So the code of conduct includes professional competence and due care, and the code of conduct includes professional behavior. Now look at this word due care in the code of conduct. Look at this word behavior in the code of conduct. Now, what is the terminology here? Code. Is code a law? Tell me. Is code a law? Waiting for your answers. Is code a law? No. Very good answer, William. Shazeb. Okay, the Sneem. So everyone agrees code is not a law, right? So Companies Act is a law, and the Companies Act is saying duty of care by law exists. But the code of conduct is saying that the auditor should exercise due care. Now, when the code of conduct says due care, do you believe this is your journal due care? This is your journal due care, irrespective of who rely on the audit report, who rely on the audit report. Is that clear to you, all of you? So the word due care in code is broader. The word due care in code is broader than the due care word in law. The due care word in law is to the shareholder. The due care word in code is the journal responsibility of an auditor, is a journal practice of an auditor to be careful, to exercise care. So is everyone clear that this due care is broader than the due care by law? Because this is your journal responsibility as an auditor when you're conducting an audit. Are you all clear? Okay. And look at this word behavior. As an auditor, when you're performing an audit, you need to exercise a professional behavior, right? So this exercise of professional behavior is your journal responsibility. So this exercise of behavior is journal responsibility of an auditor under the code of conduct, journal responsibility of an auditor. So when the auditor goes for the auditor carefully planned the audit, right? The auditor carefully performed the audit. The auditor carefully planned the audit, carefully performed the audit, irrespective whoever relies on the report. So the code of conduct and the Companies Act are two different things, right? The code of conduct is guiding you about your liability in tort. The code of conduct is broader. The code of conduct says whatever you do as an auditor, do it good. Whatever you do as an auditor, do it for everyone. But the law says, oh, only the shareholder. So is everyone clear between a difference between a code of conduct and a law? And the due care in a law versus a due care in a code? So the code of conduct is basically the tort, right? Is that clear to all of you? So the tort is your journal responsibility as an auditor, right? And I think the exposure of tort is broader than the exposure of a law. Agree, disagree? The exposure of a liability in tort is broader than the exposure of a liability in contract, right? Can I write this point here? The exposure of liability in contract is narrow versus the exposure of a liability in tort for the auditor. Under the liability in contract, who can make you liable? Under the liability in contract, who can make you liable? Answers. Okay, good, very good. And under the liability in tort, who can make you liable? Yes, good answer, Sarah, and everyone. Stakeholders means anyone. Can we use the terminology anyone? So the exposure of a liability in tort. So exposure of liability in contract is narrow versus the exposure of liability in tort for the auditor. The liability in tort is the journal duty of care for the auditor, and which exposes auditor to a greater liability by anyone. Greater liability by anyone. Now that means your exposure to liability is unlimited. So this anyone is a very dangerous word here. Liability by anyone. So the auditor will be under a lot of stress. The auditor will be under a lot of pressure that anyone can make me liable. The customer can make me liable, the supplier can make me liable, the public can make me liable, the shareholder can make me liable. Okay, fine, the shareholder is my agency relationship. But can anyone file a case against the auditor in the liability in tort? Because the liability in tort says journal. So when the liability in tort is saying it's journal, so journal means anyone can do it. So do we need to put a limit to anyone here? Should there be a limit to anyone? Should there be a limit to anyone under tort? Otherwise, things are very dangerous for the auditor. I hope you agree with me. Discussing point. Discussing point. Another discussing point. Are you all clear with this discussing point? Should there be a limit to anyone under the tort? Because if there is no limit to anyone, then anyone can file a case against the auditor. And that means the auditor will just not be conducting an audit. Auditor will be sitting in the court defending the cases. Are you getting my point, everyone? So is anyone a dangerous term? Should there be a limit? Should there be a boundary for anyone? Otherwise, the auditor liability will be unlimited. Are you getting this point? The auditor liability will be unlimited. So should there be a limit to anyone under the tort? Else, the auditor liability will be unlimited. So let's see what is the limit. Now, the limit for the tort is defined by Bannerman case, right? The Bannerman case is important when it comes to versus stakeholders and when it comes to tort. Now, the Bannerman case will be important because the Bannerman case will decide which of the stakeholders can file a case against the auditor, right? Are you all clear? Please, there is a Bannerman case summary in front of your screen. I'm giving you 2 minutes to read it, and then I will have a discussion with you. Try to understand the Bannerman case in front of the screen and try to conclude which of the stakeholders can fall under liability in tort. Your time starts now. Okay, so if you have read the Bannerman case, which stakeholder will fall under the definition of anyone now? What is the Bannerman case telling us? What is the court telling us now? Because this is an historical judgment which is now used to decide the case for stakeholders anywhere in the world. So which stakeholder will fall under the definition of anyone now? No, I'm not asking the name of the stakeholder in this case. I'm asking exactly which stakeholder. What is the verdict? What is the verdict? What is the key point of the verdict? Look at this. Auditor knew the identity of the third party. So which stakeholder can file a case against the auditor as per the Bannerman case, as per the case, as per the historical judgment of the court in the case of the Bannerman case? Not just the finance provider, Afan, any known party. Auditor knew the identity of the party. So if the auditor knew about the party before the start of the audit, then that knew will become the important perspective. Let me put it over here in this case. Bannerman case versus stakeholder. I think the most important thing from the Bannerman case is the verdict. And the verdict says the auditor knew the identity of the third party, and the statement continues. I'm not writing the full statement, right? So the auditor knew the identity of the third party. Identity of the third party, knew. Now, this is the deciding point. Now, that means when the auditor is performing the audit and when the auditor is gathering knowledge of business, the auditor may know about lots of parties which are important. So that means when the auditor is planning the audit, and is gathering knowledge of business and is gathering knowledge of business, the auditor will come to know about lots of important stakeholders. Auditor will come to know about lots of important stakeholders and their relationships with the company and their expectations as in the case of the Royal Bank of Scotland, their expectations was that the company should send them the monthly management accounts and the audited financial statement. So do you agree with me that when the auditor is performing the auditor at the stage of planning spend a very careful time on gathering knowledge of business? And do you agree that knowledge of business will help auditor knew the identity? Gathering knowledge of business. So at the stage of planning, when you're gathering knowledge of business, the auditor will come to know about lots of important stakeholder. So I'm not saying unimportant stakeholder, right? I'm saying important stakeholder. So do the company's auditor know about, for example, will the auditor know about the major banks of the company, when he's performing the audit? Will the auditor know about the major customers of the company, not the minor one, the major customers, like the major distributors, like the major retailers of the company, etc., to whom you make most of your sales, the major suppliers from which you take most of your raw materials, not the minor ones, the major suppliers of the company, the critical suppliers of the company. Will you be knowing about the major legal advisors of the company when you're starting the audit? So as an auditor, when you are performing the audit, you're gathering knowledge of the business. At that stage, the auditor know about the major ones, and you even document them in your planning working papers, right? So even the auditor documents the name of the major banks, the major customers, and the major suppliers in the planning working paper. Even you send confirmation letters to them. You send confirmation letters to bank, you send confirmation letters to customers, to suppliers even. So do you know about them? But do you know about minor customers, minor suppliers, minor banks, etc.? When the auditor is performing audits, the focus of the auditor is on material, significant, important. So is the Bannerman case telling us that if you know the identity of the third party, you will be held liable? And that third party could be anyone, right? Not just Royal Bank of Scotland. Are you getting my point, everyone? So can there be a known stakeholder and an unknown stakeholder to the auditor? So if the auditor has a known stakeholder, will you be held liable? And if the auditor has an unknown stakeholder, will you be held liable for it? So I think the Bannerman case is telling us that for the auditor is equal to knowledge of business, and knowledge of business is equal to known stakeholders versus unknown stakeholders. So auditor will be held liable for the known stakeholders, right, from the knowledge of business. Auditor will not be held liable for the unknown stakeholder of which the auditor have no knowledge. Is that clear to all of you? Is everyone understanding the Bannerman case? So is Bannerman case important in opening the definition beyond shareholders? So is it just the shareholders which will fall in the injured party now? Is it just the shareholders which will fall in the injured party now? Or will the injured party includes the known stakeholders? Now, let's broaden the definition of an injured party now. Injured party. And let's see what is the definition of an injured party. Now, when you look at the definition of an injured party, the definition of an injured party will now become shareholders, definitely, and the known stakeholders. The shareholders will fall under duty of care by law, and that duty of care by law is the Companies Act 2006. But the known stakeholder will fall under the duty of care by law, duty of care by law, and the law will now become the Bannerman case. You know that the historical judgments becomes law. So if a court is deciding any future case in 2021, 2022, they will use Bannerman case as a historical judgment. So the Bannerman case will automatically become a law in that case. So shareholders are the injured party and they are covered under the Companies Act. The known stakeholders are covered under the Bannerman case. So is everyone clear with with a broad definition of an injured party now? Any confusions, any problems? So shareholders and the known stakeholders. The shareholders are protected under the liability in contract. The stakeholders are protected under liability in tort, but the tort definition has been narrowed down by Bannerman case, and the Bannerman case says it's not anyone, it's just the known stakeholder. So the unknown cannot file a case against you. So only the known can file a case against you. So if it is a known stakeholder and he wants to file a case against you, how would he prove the duty of care by law exists? How would he prove the duty of care by law exists? By taking in the court the Bannerman case, the verdict of the Bannerman case, right? And the verdict of the Bannerman case will say, oh, the duty of care between me and him exists. Is everyone clear with this aspect? So the final perspective, and taking on the last aspect, the final perspective. Now, please, I want answers from your side. The injured party, open comma, open the bracket, shareholders / known stakeholders as above, must prove to make auditor liable, must prove or auditor negligence, must prove auditor negligence to make auditor liable by following the 3 steps below. Number 1, duty of care by law exists. Number 2, the duty of care was breached. And number 3, the breach cause loss. Now, this formula is very, very important for you to remember. For exam paper, if you're attempting any question on liability, there is only one question, which we will be doing today. So the duty of care exists. Now, you know, this exist will fall in 2 brackets. Exist either by Companies Act or exist either because of the Bannerman case. The duty of care was breached. So the breach is something which is to be proven in the court through evidence coming from the injured party, evidence by injured party. And you know the definition of the injured party now. And the breach caused the loss. Again, this is to be proven. This needs to be quantified. This needs to be quantified by the injured party so that it becomes auditor liability, right? Is that final perspective clear to all of you? Are you all sound in the discussion we had so far in the lecture 7 on auditor liability? Right, so that is it. Now, one final perspective, and we're taking on the final paper. Now, when the auditor is liable, you know that I can be liable from the shareholders and I can be held liable from the known stakeholders. Penalties can be imposed on the audit firms if there is a unintentional negligence, right? But if there is a criminal offense, like you do something deliberately, look at Arthur Andersen. There is no existence of Arthur Andersen today. Arthur Andersen liquidated in 2002 after the Enron scandal. We just have the big 4 firms today: PricewaterhouseCoopers, Ernst & Young, Deloitte, and KPMG. We don't have Arthur Andersen anymore. Arthur Andersen used to be the big 5 at that time. But after the Enron scandal, because it was a criminal offense, the audit firm was liquidated. So that can be the harsh realities you can face if you are held liable under a criminal offense. And a criminal offense is a deliberate negligence of the auditor. But if it is an unintentional negligence, what will happen to the auditor? Penalties. You will face penalties. And every audit firm faces penalties in a year, minor or major. So if there is a liability, the worst which can happen to you in the case of an unintentional negligence is what? Penalties. Right? So just write it down, and we're taking the final perspective. Just let me draw a line here, and just let me put something over here. Unintentional versus intentional negligence. Now, if you have something unintentional negligence, what will happen to you as an auditor? Unintentional negligence is equal to a civil liability, and a civil liability means a civil liability is equal to penalties imposed on audit firm, which they have to pay to the injured party, right? Simple. But if there is a intentional negligence is equal to a criminal liability, just like Enron and Arthur Anderson, criminal liability, and the criminal liability can have a severe impact on audit firm future. The regulator can blacklist the audit firm. The regulator can blacklist the audit firm, or else the audit firm will be dissolved or liquidated. Is that clear to all of you? And this is where you can take the example of Arthur Anderson versus Enron, which happened in USA. Is that clear between intentional and unintentional? So we are doing the final aspect now, limiting auditor liability, right? Which liability are we limiting? There is no limiting of the criminal liability, right? The limiting auditor liability is for mostly the penalties, right? How can you reduce your penalties exposures? Let's start with limiting auditor liabilities, and let's see what you need to know for exam paper. Okay, the last thing to wrap up the lecture, and that is limiting auditor liability. What can be some good ways through which the auditor can limit the liability? The first one, which is also part of your syllabus, you must have seen that in the block 2 of the syllabus, ways, quality of the audit work. That is the best solution, right? Improve the quality. And we know the big 4 firms spend a lot of money on improving quality of the audit work. You know, there is a topic quality control. You must have studied that in the block 2 if you've reached that point. Quality of the audit work. Is that something best? Because if the quality goes up, the negligence comes down. Is that true? And will that protect you from exposure to liability, either from the shareholder or from the known stakeholder? So is quality better? So should the audit firm spend a lot of money on improving quality, resources, policies, procedures, check and balance, monitoring, right? You must have studied the 6 elements of quality control later in the block 2. So those 6 elements of quality control, if are present, will definitely ensure that your exposure to liability is going down. Is that clear to all of you? So the first one is quality. The second way to limit your liability is, and I think quality is a more proactive way, right? I think quality is a more proactive approach to reducing liability, right? So the first way you can reduce the liability, number 1, is quality of audit work should improve. Quality of audit work should improve because this will reduce negligence. This will reduce negligence and overall exposure to liability. Overall exposure to liability, right? Overall exposure to liability. Quality of work should improve. So that improving of quality will definitely be important for limiting the auditor liability. This is a proactive approach. I hope you understand what is a proactive approach, right? Doing something before something happens. So this is a proactive approach and the best one. Next approach to reduce your liability is a practice which happens just in UK. This is a UK practice, right? This is only applicable in UK, disclaimer of liability. Now try to understand this disclaimer of liability. This is a UK approach. UK approach only. What is that? Disclaimer of liability. We're not saying disclaimer of opinion. If you've studied that in the AA paper, it's not a disclaimer of opinion, it's a disclaimer of liability, right? But this is only applicable in UK. Let's see, what is a disclaimer of liability? If you are conducting audits in UK, right? There is a section in the UK's Companies Act under the section 534. There is a section 534 in the Companies Act in UK, Companies Act, 2006. And this section in the Companies Act give auditor the power to use a disclaimer of liability paragraph in the audit report. The auditor can use a disclaimer of liability paragraph in audit report subject to a liability limitation agreement with the audit client. Now, this is very, very important for you to understand this. There is no exam importance to this, but as a student, you should know the ways to limit them down, right? You're not quoting the sections in exam paper. You just should have a knowledge what exactly is a disclaimer of liability paragraph. Now, this is a UK practice. Now, what is the section 534 is telling us? The auditor can use a disclaimer of liability paragraph. Where? In the audit report. So you can use this paragraph in the audit report subject to a liability limitation agreement with client. You can use this paragraph subject to you have an agreement with client. But if you don't have an agreement with client, can you use this paragraph? If you don't have an agreement with client, can you use this paragraph? So is that an important condition? Can the auditor use a disclaimer of liability paragraph at his or her own discretion? No. Auditor cannot use this liability paragraph at his own discretion. Rather, you need to have an agreement with client. So should the client agree with you, then only you can use the disclaimer of liability paragraph. So is the agreement with client important to use it? Tell me, is agreement with client important to use the disclaimer of liability paragraph? The answer is yes. But if the client doesn't agree with you, the client doesn't give you a permission, then you cannot. Let's take an example. Why? Let's take an example of disclaimer quickly. Example of disclaimer of liability. This is the longest one. Rest are simple. Disclaimer of liability example. Try to understand this. When the auditor uses a disclaimer of liability paragraph, disclaimer of liability para in the audit report, it's worded like following. It's worded like following. Open inverted commas. This audit report is solely for the company's shareholder. This audit report is solely for the company's shareholder. Full stop, inverted commas, close. See, this is what you are writing in your audit report. You're saying this audit report is solely for the company's shareholder. Now, if anyone else read it and he get a loss, you cannot make auditor liable. Is that an exclusion clause you're writing in the audit report to protect yourself as an auditor? Is that inverted comma protecting the auditor from the known stakeholders? Because you're saying this report is only for the shareholder. If you read it, read at your own risk. If you suffer a loss, suffer the loss at your own risk. So is this an exclusion paragraph, everyone? Is this paragraph limiting the auditor liability from the known stakeholder? Because you cannot limit your liability from the shareholders, right? You cannot limit your liability from the shareholder because they are your principal, right? But you can limit your liability from the known stakeholder. And by putting this inverted commas, you are limiting. But you need an agreement with the client. If you say this report is solely for the company shareholder, it looks good. If you are an auditor, the auditor will be so happy. Okay, now only the shareholder can file a case against you, no one else. Is that a line which will make the auditors happy and feel secured? Does this line make auditors happy? Everyone? Right? Now look at the perspective of a client. There has to be an agreement with client. Now suppose the client which you are auditing is highly geared, or is negotiating a loan from a bank which will be issued after the signing of the audit report. The company is highly geared means they'll rely on loans a lot, or the company is negotiating a loan from a bank which will be issued after the signing of the audit report, full stop. If the audit report mention, if the audit report mention, comma, if the audit report mention, comma, this report is solely for, just give me 1 second. This report is solely for the company's shareholder. Will it negatively impact, the client relationship with banks being highly geared, and the future negotiation and the ongoing negotiations Tell me, look at the case study, small one, and tell me, what do you suggest? Will the client agree in this case to give you a disclaimer of liability in the audit report? Okay, let's see the answers. Everyone is saying no, so client will not agree, right? So auditor every time would like to put the statement, this report is solely for the company shareholder, because auditor will be so relaxed after the statement. But can the auditor put this statement at his or her free will? Can you put this statement without asking the client? You should ask the client, because if the client is in the situation which I've just given you, suppose, if the client is in the situation I've just given you, suppose, will the client agree to give this paragraph? Will the client agree to include a disclaimer of liability paragraph? Right? So is there an importance of having an agreement with the client? Because the client will not agree with you in every circumstances that you include this report solely for the shareholder. So will it negatively impact the client relationship with banks being highly geared and ongoing negotiations? Yes, it will negatively impact on the client relationship, and the client will not agree to the use of the disclaimer of liability paragraph. Yes, and the client will not agree to use the disclaimer paragraph. So that's the answer. So the section 534 is not just giving you an absolute power that you can put a disclaimer of liability paragraph, but it is saying that if you want to put a disclaimer of liability paragraph, you should first have an agreement with the client. If the client agrees to you, then put it. Because for the auditor, this is a wonderful situation. But the section 534 is a very clever section. It has not given you absolute power as an auditor, right? So that is the reason that you don't find this paragraph in most of the UK reports. So you download any UK report, you will never find this paragraph, because I think in most circumstances, the companies these days are highly geared. Most of the companies relies on the bank loan a lot. Is everyone clear with the UK approach only, disclaimer of liability? But do you appreciate this is the way to reduce the liability from the known stakeholders, if that is permissible, right? If it is permissible, then is it a way to reduce your liability from the known stakeholders? Right. Okay, let's take on number 3. Okay, let me put an example. Okay, this is an example for disclaimer of liability, right? Just let me take the waste down so we can start it from the fresh page, because when you're taking a printout, it should come all on one page. Okay, examples, right? So we got the first example, we got the second example. Let's start with number 3. The number 3 way of reducing your liability, just let me present it in a better way so that you can, when you take a printout, it becomes good for you. Okay, number 3 way of reducing liability. Incorporation. You can get your audit firm incorporated. If you get your audit firm incorporated, your audit firm will become a company. Currently, the audit firms internationally are partnership. So another way, which is not realistic, no audit firm is incorporated to date. But this is just a suggestion, right? This is just a suggestion that you can get your audit firm incorporated. Because if an audit firm become incorporated, it will become a company. And you know the liability of a company is limited, right? So if an audit firm becomes incorporated, it will become a company. It will become a company. For example, Price Waterhouse Cooper, INC dot. INC dot. Price Waterhouse becomes incorporated. But if an audit firm becomes incorporated, it will become a company. For example, PwC.inc. However, no audit firm to date is incorporated. Even though that is such good thing, no audit firm to date is incorporated, because even though incorporation have benefits of limiting liability. You know, the companies have a limiting liability, right? In a partnership, you can go to the personal bankruptcy to settle the liability, right? Agree, disagree? In a partnership, the partner can go to a personal bankruptcy to settle the liability. Even the partner needs to sell his own personal assets. In the partnership, the partner needs to sell his own personal assets to settle the debt. But in a company, when the company is winded up, you will only settle the liability to the amount you have. So the company will only settle the liability the company can pay off, rest you cannot settle. So because even though incorporation have benefit of limiting liability, there are adverse impacts on audit firms of getting incorporated, like adverse tax implications. So if the audit firm becomes incorporated, will they have adverse tax implications? Will they fall under the corporate tax, adverse tax implication? And the audit firm, by virtue of becoming a company, will need to publish the financial statements. Currently, the audit firms don't publish the financial statements because they are partnerships. So even though there is a benefit of incorporation, but there are lots of disadvantages of incorporation. Are you getting my point? So incorporation gives you a benefit of limiting liability, right? That's good. That can limit your liability as an audit firm. The partners will not go to the bankruptcy. But look at the disadvantages of incorporation. If you get incorporated, you have adverse impacts. And those adverse impacts include adverse tax implications. Number one, you will be subjected to a corporate tax, not a partnership tax, which is more significant. And you need to publish your financial statements as a company. Partnerships don't publish financial statements. Sole proprietors don't publish financial statements. And you will be subjected to the audit as a company. And by virtue of becoming, you will need to publish the financial statements and subject to audit. How interesting the situation will be, right? PwC is doing audit of E&Y. E&Y is doing audit of KPMG. So this will become a more interesting situation. But currently, that's not the case because no firm has been incorporated. So do you realize incorporation is just an idea which can limit your liability? But against that, there are so many disadvantages. Is everyone clear on incorporation? So is any audit firm incorporated? Why are they not incorporating? Because the disadvantages are more than advantages. Now, the audit firms are clever. So they found, okay, there is a benefit of putting a company, and the benefit is limiting liability. But there is a disadvantage if I become a company. That is publish accounts subject to audit and adverse tax implications. So the audit firms are clever. They decide, let's do something. And they're doing it. The next thing is LLP, Limited Liability Partnership. And the audit firms internationally have become a limited liability partnership over the last 10 years. And see, they're so clever. They thought, okay, let's have an LLP, Limited Liability Partnership, and take the benefits of a company and exclude the disadvantages of a company. Limited Liability Partnership. See, so clever. They become a limited liability partnership as a matter of law. The law permits you to become an LLP, Limited Liability Partnership. LLP versus LLC. So LLC has a disadvantage, right? Company. Are you all clear? The company had a disadvantage. but the partnership has an advantage. See what you've done. In case of LLP, the benefits of limiting liability has been taken, and the of the disadvantage of becoming company has been excluded. So as a limited liability partnership, will you be subjected to an adverse tax implication? No. Will you be subjected to publishing the financial statements? No. Will you be subjected to the audit? No. You're still a partnership, but with a limited liability. So will the partner needs to settle the liability from his own assets? No, because you are under a limited liability. So all the audit firms, PwC, E&Y, KPMG, Deloitte, they've all become LLP. You go to their websites, you will see a limited liability partnership. So in the case of an LLP, the benefits of limiting liability has been taken and the disadvantage of becoming a company has been excluded. And that is a very good way of running an audit firm, limited liability partnership. So is everyone clear between an LLP and an LLC? Right? So audit firms mostly around the world, around the globe, have become LLP in last 10 years. Right? So mostly they've become LLP in the last 10 years. So no personal bankruptcies for the partner, right? No personal bankruptcy for the partners when they are settling the liability. Okay, and the last of the ways is capping of the liability. Cap the liability. This is a practice, capping of the liability, which exists in Germany only. So again, this is a Germany only practice, And in Germany, they have a law. So this is a Germany only practice, capping liability. We had a UK practice, we had a Germany practice, capping the liability. German only practice. Now in the Germany, they have a law which says you can cap your liability, capping the liability. Cap means to fix the liability, Now, this capping of liability is important. It says that as an auditor, if you are found negligent, but this fixing of liability is only for unintentional misstatements, right? You cannot fix the liability for criminal offense like Enron, unintentional negligence. You cannot have this capping of liability for criminal. I hope you're getting my point, right? So you can fix the liability, the maximum you can pay for an unintentional negligence. So in Germany, they have a law which limits the liability of an auditor by capping the liability of auditor, fixing the liability of the auditor. The maximum the auditor will pay if the audit firm is found unintentionally negligent. So the maximum the audit firm will pay if found negligent unintentionally. So will that help audit firm make a provision before? Now, what is the cap for a listed company, and for a non-listed company? The maximum liability you can pay to a listed company if you're found negligent, I think it's pound. Sorry, it's euro. It's euro 4 million. And the maximum penalty you can pay in the case of a non-listed company is euro 1 million. Just let me confirm that the exact number. I think it's the same. Yes, it's same. It's fine. It's 4 million. I think it's 3.9 million precisely, but I'm just rounding it off to 4 million, right? 3.9. So if you are held liable in a case of a listed company for an unintentional negligence, the maximum penalty that can be imposed upon you is how much? 4 million euro. And in the case of a non-listed company, the maximum penalty that can be imposed upon you is 1 million. Is that clear to all of you? So will that help audit firms? If an audit firm knows in Germany that I have 10 listed companies, can they make a provision at the start of the year of like $40 million to be on the safe side? So if an audit firm in Germany knows I have 10 listed companies And the maximum amount of penalty I can bear if I held liable is like 4 million multiplied by the 10 listed companies is 40 million. So can I set aside a provision to be on the safe side? Can that really help them as an audit firm? Are you all clear with this? The German only practice. So it's to fix the liability, but only for unintentional negligence, not for criminal offense, right? So is everyone clear on the 5 ways we discussed to limit the liability? Some of them were UK, some of them were German. LLP was more international. Incorporation was just an idea. And quality is the best approach because that's the proactive approach you can do to limit your auditor liability. Is that clear to all of you? That's wrapping up the topic. Okay, we just need to spend 30 minutes the last on the question. I'll just give you an outline of the answer, and you will then fill in the answer and email me at my email ID. So I'm just giving you the outline of this question so that you can start doing it. It's an easier one, not a difficult one. So it's just a 12 marks question. Spaniel Company, question number 4A. So let's prepare ourselves for that. And I will just give you an outlines. You fill up the answer and email me. So let's open the question June 13. No breaks, right? Okay, let's start the paper. The practice, June 13, question number 4A on Spaniel Company, which is basically relating to the topic we have just discussed, right? So just let me show you the question, give you the time to read it. Okay. Can you all see the June 13 paper in front of your screen now? Right? Okay, just let's go down to the question number 4. Okay, can you all see the question number 4 in front of your screen? 4A, right? Okay, just look at the requirements before I give you 5 minutes to read it down. Okay, look at the requirement. The requirement says, explain the matters that should be considered in determining whether groom company is liable. Groom company is the audit firm, right? Whether groom company is liable to Spaniel Company. Spaniel Company is the client in respect of the fraud. 12 marks. Okay, let's copy this and take it on my Word file before I give you time to read the case. This is the requirement, right? And the requirement is pretty simple to understand after the topic today. Okay, the requirement says explain the methods, number 1, that should be considered, the matters you will be considering in determining whether audit firm is liable, whether the audit firm is liable or not. You have to consider the matters. You have to consider the matters whether the audit firm is liable to Spaniel Company in respect of fraud, and you have 12 marks. This is quite an old question. So every matter you consider will give you 2 marks, right? So 2 marks per matter. And I'm taking the marking scheme as of the June 13 exams, right? June 13 exams marking scheme, June 13 exams marking scheme, because this question has not come again. So we don't know the updated marking scheme. But if a question like such comes for like 5 marks, 6 marks, then for every matter you will get 1 mark. But when the marks are very, very heavy, suppose you need to write 12 matters here. Can you write 12 matters in considering whether the audit firm is liable? That's next to impossible, right? So you just need to focus on 2 marks per matter for June 13 exams marking scheme, and you need to find 6 matters in determining whether groom company is liable. So you will read the case and find 6 matters to be considered in determining whether the audit firm is liable. Whether the audit firm is liable means it could be the case that it's not liable. Whether the audit firm is liable, because look at the terminology whether. The whether means that it could be liable and it could not be liable. So you read the case, you find the methods, and you will then decide whether the audit firm is liable or not. So it can be liable, it cannot be liable, right? And you will need to put headings followed by paragraphs. So every matter you identify, you will put a heading followed by a paragraph. Headings followed by paragraphs. And you will email me the full answer at AAA mock@gmail.com. Let's start discussing the brainstorming of this answer, which will help you formulate a very good answer at home. So let's start with the brainstorming. Is everyone ready? Has everyone got the perspective of the question, what to do, how to do? Okay, let's go down. See the case. The matters in determining whether the groom is liable, if we just go with the knowledge says 3 matters, right? If you just go with the knowledge of the matters from the topic we did today, matters from knowledge, topic 2. And you will say, okay, in the topic 2, we just read there are 3 matters only, and we need to make up a 6 matter answer. So there might be something in the case study as well, right? But if I just go with the matters from the knowledge, there are 3 matters. Duty of care exists. That will become my first matter for 2 marks. The duty was breached. I will prove that and will fetch another 2 marks, right? Then breach cause loss. I will try to prove the loss for 2 marks. So as per the knowledge, I can take 6 marks, right? By linking duty of care with the case study, by linking duty was breached with the case study, by linking breach cause loss with the case study. Is that clear to all of you? But that means there must be some case specific matters. There must be case specific matters too, which needs discussion. So I think we have roughly have 6 marks for case specific matters, right? And 6 marks coming from the knowledge of the topic 2. Is that clear to all of you? 2, 2, 2, and then 6 marks, making up a 12 marks answer, right? Okay, let's start doing the brainstorming now. Now, the first 5 minutes will be yours. I'm putting the case in front of you. Can you all see the case back again on screen? Can you all see the case? Okay, start reading it. Start reading from you are a manager from here and stop reading at the last point here, conducting the audit. So you have 5 minutes to start it. 5 minutes to do it, sorry. Your time starts now. Okay, so do you believe a groom company is liable as per the case study? Okay, let's find the answer. You are a manager in Groom, a firm of chartered certified accountant. You have just attended a monthly meeting with the partners and the managers at which the client matters were discussed. The first client is Spaniel. Let's see what are the issues and are we liable, right? Let's see whether we can conclusively conclude auditor is liable in respect of a fraud. The audit report on the financial statement of Spaniel, a long-standing client. Now, obviously, when a client is long-standing, normally we lose our professional skepticism. Is that true? When a client is long-standing, we are doing audit for it for the last 5 years, 6 years, 7 years. Normally, we become reluctant, right? And the amount of professional skepticism starts to go down. I believe this is something where things can be discussed in brainstorming. Number 1 point, which you should relate from the case, is that it's a long-standing client. And when the client is long-standing, generally, the audit firm lose skepticism. It is generally, right? Generally, the audit firm lose skepticism and become more reluctant to work because you believe everything is fine. We've been doing audit for the last 10 years, 7 years, 8 years. Reluctant. The audit firm becomes more reluctant to work. That's number 1, right? Number 2, probably that might be the reason you overlook things. For the year ending 31st of December was issued in April 30. So the audit report was issued, right? And you issued an unmodified opinion in April 2030. We know the audit is done after the year end. So after December 12, you must have started the audit in January 2013. And you wrap up the audit and you issued the unmodified opinion in April 2030. So the audit report has been issued, right? In May 2013, that is 1 month after the report was issued. So 1 month after the report was issued, Spaniel Company Audit Committee contacted the partner to discuss a fraud which was discovered. So when they discovered the fraud in May 2013, they contacted you as a partner. And the audit committee is telling that this fraud is operating, the estimated amount of the payroll fraud is $4.5 million. So we have an estimated loss, which can be the liability. It is operating since May 12th. Wonderful. This was operating since May 12th. And what is the year end of the company? December 12th. So how long it has been operating? May, June, July, August, September, October, November, December, up to the year end. Up to the year end, how long it was operating up to the year end? 8 months. So the year end of the company is December 12th. It was operating since May 12th. So how long it was operating up to the year end of the company? Everyone. And the audit committee discovered it in May 2013. And they contacted you as a partner that we discovered a fraud in payroll. Interesting. Now that brings good answers here. The question is asking, determine whether audit firm is liable in respect of fraud. Now, firstly, you need to speak of the fraud discovered by management, fraud discovered by audit committee in May 2013, which was operating since May 2012. So up to the year end, December 2012, the fraud was operating for 8 months. Now, the auditor overlooked that when he was conducting the audit. 8 months is a big time. So now look at the situation. You need not to put the entire blame on the auditor here, because you need to agree one thing, that for the fraud, there is a management responsibility primarily. And for the fraud, there is an auditor responsibility as well. So you can gain your 4 marks here. You cannot just say, okay, everything is the responsibility of groom company. No. Where was the management? Was the management sleeping for the last 8 months? Where is the internal audit department? It seems there is no internal audit function, or the internal audit function, if it is there, wasn't working as well. So if there is a fraud which is operating for last 8 months, and if the fraud was operating for the last 8 months and the audit committee come to know about it in May, then what about the auditor? The auditor is doing audit in a time pressure. The auditor is doing audit on a material basis. The auditor is doing an audit within a stipulated time. Who is inside the company? Who was inside the company when the fraud was taking place? The auditor or the management? Who was inside the company when the fraud was taking place? The management. So management responsibility is primary as per the ISA 240, is primary, because management is present at the time, when fraud was occurring, or the fraud was occurring. So when the fraud was occurring, the fraud was happening, who was there in the company? The management. So management has the primary responsibility as per the ISA 240, right? Which we will be covering later in our topics. ISA 240, fraud, says it is the management which is primarily responsible for preventing the fraud and detecting the fraud, because they are the one present in the company. So it is primarily the management responsibility to prevent and detect fraud. Is that clear? So management is responsible to prevent it. They didn't. It happened. Detect. When they detected? 8 months after. They detected in May 2013. They detected it almost after a year. So management prevented the fraud? No. They failed to prevent it. And they detected the fraud. When? In May 2013. When the fraud took place? In May 2012. So full stop, and you write in the bracket, the management detected the fraud almost 1 year after. So who is to be blamed here? Primarily the management. You cannot say everything is the groom company. No, we believe groom company is liable, but not 100%. It was the management's primary responsibility to would have prevented the fraud at the first place. They didn't. They detected it after a year, almost 1 year after, in May 2013. Full stop. Is that clear to all of you? So you need to be a bit critical of the management here as well, right? So you will gain 2 marks when you tell about management responsibilities in terms of that there is a certain element, a certain blame which the management should take as well. You cannot put the entire blame on the auditor. And you also need to tell Yes, because it was a long-standing client, there is a journal perception that the auditor lose skepticism and become reluctant to work. So that might also increase the negligence factor for the auditor. You can fetch 2 marks from this point as well. Is that clear to all of you? Then you speak of the auditor responsibility, that the auditor responsibility is secondary. Auditor should carefully plan the audit uh, with professional skepticism, realizing the fact that financial statements could be materially misstated. So this is what the auditor should have done. Auditor should plan the audit with a careful professional skepticism, realizing the fact that the financial statements could be materially misstated. So I think groom company is also liable to a secondary extent because they should have planned the audit with an attitude that there might be a misstatement in the financial statement. And I think we should blame them as well. 2 marks for defining the responsibility of an auditor. So that what is the responsibility of an auditor when it comes to fraud? But you also need to speak of the auditor responsibilities with limitations. Auditor have limitations, right? Audit is done on sample basis. That's one limitation. So you cannot put the entire blame. Even if you plan the audit wonderfully, what if it doesn't comes in your sample? Audit is done on a material basis, What if the fraud is immaterial, for example? It will not fall under your material definition. Then you cannot hold the auditor liable. So when you are arguing that groom is liable, you need to speak of the management responsibility first and gain marks. You then need to speak of the auditor responsibility journally and gain marks. You need to speak of the limitations that auditor cannot be held liable absolutely because auditor has a limitation of a sample basis. Auditor has a limitation of a material basis. I hope you're getting my points here, everyone. So limitations can fetch you 2 marks as well. Is everyone clear? So far, so forth, what I am discussing and writing on the screen for all of you. Are you finding that absorbing? Is that absorbing? This is pretty much F8 knowledge. This is pretty much AA knowledge. Nothing to do with the AAA knowledge, what I'm discussing currently, right? Okay, lastly, now let's see. Yes, Majid, I'm coming to that point, right? I'm just generally discussing that audit is done on material basis, right? But in the context of the case, yes, it was material, right? So I'm just coming to that point. I'm generally discussing the responsibilities of the auditor. Next paragraph. The audit partner commented that neither test of controls nor substantive procedures were conducted on the payroll in the latest year's financial statement. And there is no, as in previous year, there was no deficiencies found in internal. Look at this statement. Neither test of controls were conducted nor substantive procedures were performed. This is absolutely illogical. Now, when you put this statement in focus, this is bringing a pressure on the auditor, the way the auditor has performed the audit. And you need to understand this is to be done with something long-standing client. Because it was a long-standing client, this is a problem. Just give me 1 second, sorry. Look at this point, right? Neither the test of controls were performed, nor the substantive procedures were conducted on payroll. Is that a very big negligence on part of the auditor? And what is the reason of this negligence? The reason of this negligence is that in the previous year audits, there were no deficiencies in the internal control. And that distracted you because you were conducting the audit of Spaniel company for the last many years. Look at this point number 1, long-standing client, and link this point number 1 with the point we are discussing. Because it was a long-standing client, you have already lost your skepticism. You've already become reluctant. And because in the last year, there had been no problems in the payroll, so you thought, okay, let's do nothing. Not even a test of control, not even a substantive procedure. Can you skip both? This is serious, right? Neither test of control nor substantive procedures were conducted on the payroll. This is very serious. So you need to speak of the negligence here and fetch marks. This is the negligence, right? This is the negligence for 2 marks. And this is a very clear negligence on the auditor. Is that clear to all of you? So duty of care exists between spaniel and groom, yes. Was it breach? I think this statement is telling us it was breached. And did the breach cause loss? But you cannot put the entire blame of breach on the auditor because the management themselves detected the fraud 1 year after. And the management is working throughout the year. Auditor is working for a limited time. So auditor is working for a limited time and the management is working for the whole year. You cannot put the whole blame on the auditor, right? But yes, this paragraph is a clear breach and the breach caused a loss. How much is the loss arising from the fraud? Okay, the total assets of the company are $80 million. And Spaniel company is considering suing Groom for the total amount of cash stolen, claiming that this was the negligence of the auditor. So they want to sue you for $4.5 million. And the total assets of the company are $80 million, right? So total assets of the company are $80 million. And the amount of fraud is $4.5 million. And that's the amount of claim. So what is the amount of claim they want to file against the auditor? Claim of $4.5 million stolen. So this is what is the loss they want to claim from the auditor. Now tell me, is this something where you can write up the answer? You have so much information in the case about duty of care exists, breach, loss. You have so much information about management responsibility, auditor responsibility, which you can use on the sideline. It was a long-standing client, which really brought the reluctance. So will you be able to draft a 6-paragraph answer here? Right. And one last thing, you need to comment in the AAA paper. You need to comment in the AAA paper where possible on materiality. This is a very important tutor advice. And let me demonstrate that for you. Tutor advice. You must have seen this in the block 2 as well and the block 3 as well. Comment in AAA paper where possible on materiality. Now, you know, something is material if you forgot that. And I can give you that ray of hope here. I hope you know the materiality threshold. Something is material. Something is material if it is 1 to 2% of the total assets. Something is material if it is 5 to 10% of the profit before tax. And something is material if it is half to 1% of the revenue, right? So in our case, do we have the total assets given to us? Total assets are $80 million. So something is material. For us, what something is versus the payroll fraud. The payroll fraud is $4.5 million so far. It might be more than this, right? It's just an estimate. It's just an estimate. It might be more than this. So what will you do? You will divide $4.5 million, $4.5 million with $80 million, and you find a percentage. Can you give me a percentage? 4.5 divided by $80 million of the total assets. Okay, 5.6% of the total assets. So is it material? 1 to 2% and thereafter. So anything 1 to 2% of the total asset and thereafter is material. So is this material? Yes. So anywhere you comment on the materiality in the AAA paper, 1 mark is given by examiner. So when you calculate the materiality and you comment on the materiality anywhere in the AAA paper, you calculated 5.6% and you commented it is material, you will fetch 1 mark out of the total 12 marks. So this 1 mark is so easier, right? That you're commenting that this is material to the total assets and the auditor should have considered payroll as important. You will criticize the auditor. You will say that neither test of controls were performed, nor substantive procedure is very wrong because this was a material area of the financial statement. Generally, audit is performed on a material basis. So this was a material area, right? So I hope you have some ray of hopes to draft an answer. Can all of you be able to sit down and sketch a 6-paragraph answer? I think the scenario is not difficult. The knowledge coming from the ISA 240 fraud, generally knowing what the auditor do, generally knowing what the management do. I hope you can able to draft a good 6 points answer, right? And Majid, I hope you're clear on your point of materiality, right? Which you raised in between when I was conducting the lecture. So definitely it's material, right? So this is a tutor advice which you have to follow. Okay. So please email me the answer on the basis of this brainstorming here. I hope you had a productive class today, the lecture number 3. So you only have one assignment, if I can just write that down for you. Assignment and what's next in lecture 3. What's next in lecture 3? Because that's very important for you to plan the next class. Akshi, it's subjective. Will the auditor pay the entire 4.5 million? Because the management wants to file a suit against 4.5 million. But again, the auditor will be doing the argument in the court, telling that it is not just our responsibility, it is also the management responsibility. So it's very subjective, because that is something the court will decide whether you will pay the full amount or not. But currently in the case scenario, the management wants to claim from you the $4.5 million. So that's the number you will use throughout your answer. Is that clear, Akshi? Okay, just let's plan the next class and what's the assignments. I think that helps you a lot. Assignments and what's next in lecture 4, sorry. We were in lecture 3 today. What's next in lecture 4? Number 1, your assignments. Your assignments is what? You need to read the article, auditor liability, number 1. And number 2, you need to complete the question and email me. That is June 13, question number 4A at my email ID AAA@gmail.com, right? So that's important. Then what's in the lecture 4? What's in lecture 4? The lecture 4 will focus on topic number 3, which is professional skepticism with the past paper. Professional skepticism as a very important topic, because there are lots of past papers on it and past papers. So we'll spend the entire class, lecture 4, on professional skepticism and the past papers. Is that clear to all of you? I hope this assignments and what's coming next help you plan your next 1 week, right? So that is it then. We were discussing the topic 2 today, which is basically the auditor liability. We did the past paper and I did recommended you the auditor liability. So this is Kashif Kamran, your tutor, signing off from the AAA Smart course. And we were discussing the topic 2 inside the lecture 3 today for block 1. I'll see you back with the lecture 4 next week. Till then, take good care of yourself. Do the assignments and email me. Take good care of yourself. Have a nice day. This is Kashif Kamran signing off from lecture 3 of the AAA Smart course.